Hello Gunners, welcome for our newest video. I hope you guys had a great weekend and you guys are ready for next week. In this video, I want to quickly talk about diversifying your portfolio. By the end of this video, you will know what Diversify is, how to diversify your account, and how that helps you, especially if you are a long-term investor. What is diversification in investing? Diversification is a technique that is used to reduce risk by allocating investment across various financial instruments, industries, and other categories. The goal of diversification is basically to maximize your return with lowest possible risk exposure, and that also helps to reduce your account volatility. For example, if one particular sector or a particular stock is crashing for a week, a month, that will not affect your whole account because you have other stocks that are probably replacing those losses during that period of time. And how can you be diverse in your portfolio? Let's say you want to open an account and you want it to be as diverse as possible. How can you accomplish that? Well, that can be accomplished by purchasing shares in different companies, asset classes, and industries. For instance, a diversified investor's portfolio may include stocks consisting of retail, transport, and consumer staple companies, as well as bonds and golds, both corporate or government issued. There are many diversification techniques. The most common one is to pick a few great index fund, mutual fund, or even ETFs that has great histories and great companies within them. This allows investors to maximize returns by investing in different companies that would each react differently to the same event by owning those funds. Plus, it is automatically being managed by those people who are responsible for nothing but the success of those index funds or ETFs. So it's less headache when it comes to actively manage your own portfolio, especially if you have a busy schedule and you have other things to take care. Every investment has their risk. Even investing in an ETF or index fund also have their advantages and disadvantages. So some advantages for ETFs or index funds, they are easy to understand and they have high liquidities. You can diversify your portfolio by buying many stocks from different sectors in order to avoid having too much risk. They are professionally managed. That means you spend less time worrying about the next move of a stock because the professionals are doing that for you automatically. And there are also disadvantages because it's not flexible and you can have limited gains. They can set the amount of gains you can have. For example, they have average returns. For example, every year on average, this particular sector or index fund have 8%, 10%, or 5% return a year. Let's say you don't have that 5% return a year and it's negative, so you're gonna have to wait another year to probably make up for that loss. Another way to do it is by self-managing your portfolio. By that I mean you will technically manage your portfolio by modifying it whenever necessary. To minimize your risk in this way, it's always great to pick out stocks from different sectors in order to balance your portfolio. This way, when one or two stocks in your account are having a bad week or a bad month, your whole portfolio will not suffer too much because others will go up and make up for that loss. For example, sometimes interest rates go up and they go down, and investors who invest in banks would also invest in real estate and vice versa. The reason for that is when interest rates go up, it's good for the banks, they're making money, and bad for the real estate markets. And when interest rates go down, real estate markets are great and banks are not doing so good. That way, no matter which season you are in, you're not worried about your account being so volatile and your account declining at a fast pace. On the other hand, if you put 100% of your money in one area and there's a crash, you would have to be looking at your account going down, and there's basically nothing you can do about it besides cutting your losses, which is not so great because you will lose most of your money in that way. By the way, no investment is without risk, but most investment professionals agree that diversification is the most important part of reaching long-range financial goals while minimizing your risk. While diversification helps you to reduce your risk and help to manage those risks into being as low as possible, how many stocks should you be investing in, or how many sectors should you be investing in order to consider your portfolio diverse? Well, most people would argue that an investor can achieve optimal diversification with about 20 to 30 stocks or any other types of investment across various industries. Beyond that point, adding one stock to your account or adding one more stock to your portfolio will not really make a significant difference unless it is a large amount. Unless you buy another stock that can cover a large percentage of your account, it will not necessarily make any difference. Why should you diversify your account, and why diversification is a great idea? It helps to spread your assets. Diversification reduces portfolio volatility, and as we said before, it can possibly boost your returns. For example, in stocks, considering investing in companies of different sizes, in different sectors, diversifying also helps you to reduce your losses. Let's say, for example, one year you had a bad return of negative 5%, and the next year you have a gain of 8% overall for the whole year. That means you erase that previous loss you had and replace it with another 3%. So that's another benefit of diversifying your account. And it also allows you to get passive income in the form of dividend. That way you can generate cash. You can be less stressed about your next paycheck. You don't have to worry about your paycheck from your job, but you also have dividend coming in the form of cash from your portfolio. In the end, always remember, diversification can help an investor manage risk and reduce the volatility of an asset's price movement. Remember, however, no matter how diversified your portfolio is, risk can never be eliminated completely. So thank you guys for watching this video. Always remember to give this video a like and share it. If you haven't already subscribed to this channel, we would love to have you as part of the family. And please invest safely.